Hi there. I'm champion algo trader Kevin Davey, and today I'm going to look at the book The Man Who Solved the Market because I found some interesting things, some controversial things maybe, that you as an algo trader should know. So let's get started. So, first of all, if you don't know about this book, The Man Who Solved the Market, it's about Jim Simons, who ran Renaissance Technologies, a big hedge fund, for a number of years and did extremely well. So the first question you might say, hey, does algo trading even work? Jim Simons really proved it. He averaged, his fund averaged over 66% annual returns for 31 years. And you might think that, hey, doing so well, life was just a nice ride for him and things were easy. But I'm going to show you some things from the book that will make you realize that, hey, algo trading's kind of hard, and, it was far from certain what the outcome of what he was doing was. So he survived, he did great, and there's lessons for all of us here. So the first thing I saw in the book, he had a quote where some of his managers, some of his the people who were helping to run the fund, they weren't doing so good. Their models weren't doing so good. This is early on. And Jim Simons actually said, hey, if you want somebody to look at who's doing really well, look at what Madoff is doing. And if you don't know who Bernie Madoff is, he had great returns for a number of years, or at least he showed great returns for a number of years. Lots of people invested with him. He was the toast of the town in New York. And then it came out that he was just a fraud. So Jim Simons was actually at one point at least fooled by Bernie Madoff. And that is a really important lesson, because what good do we have if somebody like Jim Simons was fooled? So watch out when you're looking at the investment space, because even the greatest algo trader of all time was fooled by someone. Filled. The next point is something that Jim Simons decided to start doing. There's a lot of research papers out there that are created by doctoral students, PhDs, and he was hoping to get some good trading ideas from them. So what he had his staff do, some of his senior guys, they would have to research 3 papers a week, and then they would sit around and have kind of like a book club where they discussed the papers and discussed the merit of the trading strategy. And a lot of times they'd actually have people at Renaissance actually program the strategies and see how they actually did. And the interesting thing, one of their leaders, one of the guys involved with this project, his conclusion was, anytime you hear financial experts, remember it's all nonsense. Meaning, they did all this review of these research papers, and what they found is most of the time the conclusions of the papers did not hold up. I've certainly seen that in some of the papers I've looked at, where you can immediately, as a trader, I can immediately see that the people writing the paper did not trade at all, never traded, and they were just working with theoretical things. And you notice that when you start to look at, hey, they didn't include slippage and commission in what they're doing. And, they seem to cherry pick what their results are. So you got to watch out for those research papers. Some people think that's the pinnacle. And it's not to say you can't get good ideas from it, but just go in with the mindset that one of the top guys at Renaissance had, that just remember, when you hear those experts, it's all nonsense. And if you go in with that attitude, you're less likely to be fooled by them. Okay, so another important point is, as an algo trader, you always think, hey, I've got to follow the models. It says buy, I better buy, because I want to do what the back test is doing. That's certainly how I like to approach things. But what was interesting is there's a couple times in the book where during times of market crises, Simons tended to pull back on certain signals. He would underweight things. He would start to not believe his models. So he believed them when they were going good, but when they started to falter during market turmoil, he would dial back. And that caused a lot of strife in his firm because there's certain people who are like, you gotta follow the algo. What are you doing? And sometimes he would overrule it. And usually he was trying to overrule it when he was really worried that maybe the fund would go under and collapse. And you say, well, but wait, he had 66% returns before fees for over 30 years. And yet he was worried that things were just going to break forever? Yeah. So remember that when you're algo trading and developing systems and running through drawdowns and live trading. Hey, there's always times of doubt, and even the best in the business had it. The next thing I found in the book is a lot of people like to have a reason for a signal or an algo, a reason why they're buying that makes sense. The problem is a lot of people think of the reason after they buy or after the signal, and they say, oh, this must be what's happening. And in that case, you're just kind of inventing reasons a lot of times. It doesn't really matter. But the bigger thing is, do you really need signals to make sense? And what Renaissance found was, hey, they have signals that make no sense, that they couldn't understand. And this isn't people who have bachelor's and master's degrees. These are PhDs, top of the line physicists and statisticians and people with AI backgrounds, all this stuff. And they said, hey, there's signals you can't understand. And these signals sometimes are strong enough to actually trade. So remember that the next time you create an algo that you don't understand why it works, or maybe what you think should have worked, maybe the opposite works really well. Just remember, you don't necessarily have a reason. And that's just not me saying it, although I've thought that for a long time. That's the people at Renaissance telling you that. That's a pretty big deal. So another big thing, I always talk about emotions in algo trading, and there's people out there who say, oh, hey, you can be emotionless, just algo trade. Okay, what does Renaissance think of that? Well, back in 2007, and this wasn't the only time, but 2007 in particular, Jim Simons was scared his fund would blow up and took major overriding of his models. So he didn't know where the bottom was going to be, so he took action outside of his algos. And it was because he was scared, basically. That's what the book says, that he was scared that things weren't going to work out. And think about it for you and me as retail algo traders, when somebody of Jim Simons' reputation and experience starts to worry and starts to override algos, emotions are part of algo trading. So don't let anyone ever tell you that they're not. The next point, you'd think, hey, Renaissance, remember I said all the team of PhDs and the physicists and the statisticians and all these guys, you would think they're doing great. They're winning, 80% of their trades and 90% of their trades. Well, it turns out the number is more like 50.75. And I think they did to 2 decimal points to show, hey, we have a lot of data behind this. It's pretty exact. And Robert Mercer, one of the leaders at Renaissance at one point, his quote was, you can make billions with being right only a little bit over 50% of the time. So they had a lot of losing trades. They were not afraid to lose. So remember that the next time you see something that says, oh, hey, you got to win 70% of the time, 80% of the time, in reality, you could lose even if you won 50.75% of the time if your reward to risk was off. So you've got to have that right too. This is only one part of the number. And I have some videos on my YouTube channel where you can learn about that, learn why the two numbers are really important, both the reward to risk and the winning percentage. You need them both. But the point here is Renaissance lost on a lot of trades, and look how good they did. That's pretty neat. So we're talking about market turmoil again, because that's when you start to doubt your algos. When the market starts to become chaotic, you're going to doubt what you're doing. You're going to doubt that your approach works. You're going to think, this is it. This is the end of algo trading. So back in 2018, the market fell by 10%. At that point, Jim Simons was already worth billions and billions. Probably, I think the book said like 27 billion or something at that point. So he personally didn't need to worry. The market could collapse a ton and he'd still be okay. Yet, again, he considered overruling his models with what he called gut instinct. He actually started to reach out to people who were more traditional investors, the people who maybe use their gut or use a lot more analysis of balance sheets and that kind of thing, as opposed to straight math models. So he reached out to them and tried to figure out, well, where's this going? Is it going to get much worse? And that just tells you, even though he had these great models, and you can't argue they aren't great with his performance, even with those great models, he was still scared, still considered overruling those models, still wanted to go with his gut. It's pretty interesting that that's how he acted, even though he had such a successful fund and career. He was still leery. And so that's a great lesson for all of us, because we like to think, we're just going to follow those signals. It's not always that easy. And the final point I want to bring up, and the big takeaway here, is algo trading's not easy. Even for the best in the business, which was Jim Simons, Renaissance Technology, 66% over 31 years before fees. Even for him, it was not that easy. And there were times where things were going wrong. There were times where it looked like all was lost. It wasn't this smooth, nice curve that everybody likes to imagine themselves with. There were ups and downs. And that's the big takeaway here. Algo trading, not easy. So I highly recommend you read this book. I have a link to it in the description. Just click on it. You can buy it. I tend to read it. I've read it, I think, 3 times now. So every couple of years I read it, and I pick up new things every time, and new insights, and just new ways to think about things. And I know I'm learning from the best there. So I think you should read it. You'd learn too. Hope you liked this video. If you did, give it a thumbs up. Subscribe to my channel. Leave a comment. What did you learn from this book? Maybe something I hadn't talked about. Maybe something that jumped out at you. I'd love to hear it. I'm Champion Trader Kevin Davey. Have a great day.